Welcome back. Looking good after the test. Hopefully it didn't drain you too much. It is a foundational part, the first 4 chapters, that allows us to now move forward. And you can expect test 2 to be a lot lighter in terms of how many chapters is included in it. There will only be 2 chapters in the next test. Okay, that's what, if you found the first one heavy. But overall, now we have a foundation that we can use to focus on inventory for this chapter, because inventory is the focus in this chapter. How do we manage it? What are the 2 main systems in managing inventory? And how is the income statement changed depending on what type of income statement we are preparing? So there will be external reporting income statements, 2 of them, and there will be 1 for internal. Okay, so we'll just explain the differences between those. Internal meaning that it's going to everybody within the company. Remember, we talked about in chapter 1 stakeholders, and we have internal stakeholders and external stakeholders. So that's the association to make with that. But mainly it's about inventory, this chapter, and those 2 systems, periodic and perpetual. Grasping that. And then later, we'll talk about taxes. How a business perceives taxes, how it manages taxes, how it communicates taxes to the CRA, Canada Revenue Agency. And the reason why taxes is part of this chapter is because you're dealing with inventory. What is the purpose of having inventory? To sell it. And if you're selling it, you're first purchasing it, and either way, you're paying taxes, whether you are purchasing from a supplier or vendor, or you're selling it to a customer. Taxes are going in one of those directions. And therefore, they need to be accounted for in both directions, and we'll explain the relationship at that point. But the main part, inventory. And now we know if we have inventory, we are a merchandising company or a retailer. And a retailer is getting their goods to sell from either a supplier or a wholesaler, okay, where for the purpose of selling. So you're purchasing the goods. Remember, we talked about assets, and we have our whole list of assets. Some of those assets are used in the operation of our business, but then some are set aside just to sell. They're products just to sell. In other words, we're not using them in the operation of our business, such as supplies or machinery or equipment or vehicles. Those are all things we are using in the operation of the business to generate revenue. But we're not necessarily selling those things. But when we talk about inventory, we purchase the inventory asset, whatever the product may be, for the purpose of selling it, not using it ourselves. That's the focus here. Inventory for the purpose of selling it. And when you hear the term purchased, you are saying, you are referring to the purchase of inventory. Okay? So to be clear on that, so that we know how we can move forward in this chapter. We will first start with recording transactions in a periodic versus a perpetual system for purchases. And then we will do sales in each of those systems. How to record the transactions and why we are recording them that way. And this is the main part of the chapter. Be clear on the differences between periodic recording and perpetual recording. Okay? So first, let's start off with just distinguishing generally the difference between the 2. Periodic and perpetual would just depend on the level of your inventory. So if you have a very manageable, low amount of inventory, you are able to implement the periodic system, which is less thorough, less detailed, which obviously means the perpetual system is more thorough and more detailed, more frequent, perpetual. So if you really know your inventory, if you have a handle on how much inventory is coming in and out per week, per month, per day, then you don't necessarily need to be so thorough because there's not as much to track. And therefore, you could be using a periodic system, which is just going to do a physical count of that inventory at the end of the period. So if it's the end of the month or the end of the year, the manager or the owner of that business will be confident enough to determine the amount of inventory on hand physically at the end of the cycle. Whereas the perpetual system is doing it more ongoingly, more frequently, because there's a larger amount of inventory to keep track of. And therefore, more difficult to just do a physical count or just to know off the top of your head. You have to really make sure what is coming in and what is coming out, because that will affect how much you're ordering, how much you need to order, right? So it just depends on the level of inventory as the main deciding factor on whether you're using the periodic or the perpetual system when managing your inventory. Okay? So again, we will record purchases under each system first, and then we'll record sales under each system. Okay? But firstly, let's go periodic and perpetual. Again, perpetual, more detailed, more frequent, and it usually will be already programmed into a software that is keeping track of your inventory for you, because there's so much to track, so many different inventory items, categories of them, and in the age of this technology and all of the software available, these systems are in place to help you manage that. Okay? Again, the periodic is more of a simple operation where you're sure, based on history, based on past patterns, what you can expect to still be on hand, and therefore be your starting inventory in the next period and as you go along in the business. So again, first, purchases. Let's say, well, first we'll make an association. Since perpetual is always keeping track of inventory after every single purchase, after every single sale, all right? Periodic is not necessarily keeping track of it after each purchase and after each sale. Okay, so we'll make distinctions as we go through. So since you want to get an updated idea of the value of your inventory on whatever day that it is requested, you are going to always be using the inventory account when journalizing under the perpetual system. The merchandising inventory account. Whereas in the periodic system, you are not using the merchandising inventory account. Okay, so it just goes along with the fact that we say we don't need to see the everyday updated idea of how much is in inventory in the periodic system, because we're doing that physical count at the end of the period. Okay, whereas in the perpetual, you are always updating inventory after each sale, after each purchase. So now let's say on March 1st, you're making a purchase of inventory, $200 worth. How do you record that transaction in each system? So I'll do it in this kind of table, but you already know that how to journalize it. We're going to do this journalizing in this table just to show the comparison between the two systems. All right. So first, we're purchasing $200 worth of inventory on March 1st, and again, the purpose of us purchasing it is so that we can sell it. That's why we have the inventory. To sell it only. So we have to record the purchase of it in the periodic system since we're not using the merchandise inventory account. Since we're not using that account, we are calling it, we'll say here, debit. The debit on March 1st under the periodic system will just be purchases. That is the account name, purchases. And remember earlier in the video, we make that association with inventory. Purchases is talking about inventory. So that's why you can just say the word purchases and we know that it is referring to inventory in the periodic system. But in the perpetual system, well, actually, I'll do both accounts in the periodic and then we'll go to both accounts in the perpetual. So the credit in the periodic will be, what do you think? Right, how we pay for it. If we pay for it with credit, accounts payable. If we pay for it with cash, cash. In this case, we're going to do accounts payable. And you'll see why when we get to the other examples. But we'll do accounts payable as the credit because we bought this inventory on account. We used our credit card. That's the entry to record a purchase of inventory in the periodic system. But in that same entry in the perpetual system, so here's our debit line, credit line, you get the idea, and then the two columns to separate the systems. The debit in the perpetual system will not be purchases, it will be, what are we always needing to have an update on in the perpetual system? As frequent as possible, after each sale, after each purchase, the updated inventory. That's why we use merchandising inventory as the account to debit in this transaction. So again, it's the same transaction, just two different systems. Merchandising inventory, which is of course an asset, inventory is an asset, that's why it gets debited, we're purchasing it so it's increasing. Debit merchandise inventory, and then we can still credit it for the same accounts payable because we purchased that inventory on account or on credit. Okay? So right away you see the difference. What periodic calls purchases, perpetual calls merchandise inventory. Because we need to always have an updated value of inventory whenever it is requested. These guys right here, periodic-minded people, periodic-minded businesses, feel like they can tell you what their updated idea of merchandise inventory is because they're so familiar with the processes of their business, the ins and outs of the inventory in their business, that they can just physically count it and they don't need a system, a sophisticated system to keep track of multiple inventory items. Okay? So there you go. The purchase on March 1st. Now we have two accounts that are going to be related to purchases, which will decrease purchases. And those two purchases is a debit account. Okay? It's considered an expense account, a debited expense account, right? Expenses are debits. The two related accounts to purchases are called purchase returns and allowances and purchase discounts. Those two will be considered contra expense accounts because they decrease purchases, and therefore are natural credits. Purchase returns and allowances, and purchase discounts. So let's branch that out over here. Purchase R plus A, returns and allowances. I know you love my short forms by now. Purchase R plus A, returns and allowances. That is one account name. We'll explain what it means, but the other one for now is purchase discounts. So I'll put disc. Okay. First, purchase returns and allowances. Let's define it and then do an example on how to record it if it happens. Purchase returns and allowances, you'll notice, has the words returns and allowances. So the return part is as it sounds. We purchased it. You think about it very practically. You purchased the inventory, but now you are going to return some or all of it for whatever reason. It could be something wrong with it. Maybe it wasn't what you ordered. Maybe it was less than what you ordered or more than what you ordered. A different color. It wasn't what you were expecting. Whatever the reason is, you return it. It will, if that happens, that's the event. If that happens, you're going to record it under the purchase returns and allowances, whatever value you are returning. But then the allowance part of it means that you're not returning it, but you are expecting a deduction in the price because there was something wrong with the shipment. So the reasons could be the same as with the return. It could be a different color, a different size, not enough of it, too much of it, the wrong product completely. Whatever it is, maybe it's a completely different product, but when you actually receive it, you are happy with it anyway. And therefore you'll keep it, but you're going to notify the vendor or the supplier that it wasn't what you ordered and you expect a deduction in the price. Just depends on the relationship with that supplier to see if they would give it to you. But if they do give it to you, then it's a purchase allowance. But either way, whether it's a purchase return or a purchase allowance, you are calling it purchase returns and allowances in either scenario. That account, those words stay together. So let's suppose now on March 5th, here's our dates. Okay, here's our little side note. March 5th, we are returning some of those goods. Yeah, this might work. We're returning them. So how do we record that in a periodic system? How do we record the return in a perpetual system? Again, in the periodic, let's just follow logically. If they're using the purchases account, they are also going to be using the purchase returns and allowances account. And when we get to discounts, they'll also be using the purchase discounts account. Okay, and so by the way, the amount here, yeah, let's just keep it like this. What do we say, 200, right? We purchased 200 inventory on March 1st. Now we're returning, let's say, $50 worth. We're returning $50 worth in the periodic system. We know that purchase returns and allowances is a contra expense. If it's a contra expense, since expenses are natural debits, purchase returns and allowances must be natural credits. But we want to list what we are debiting first. So what do you think we would be debiting if we're returning $50 worth of this 200? $50 worth of this 200 we are returning back. That means they were expecting $200 from us, accounts payable, our debt. But if we're returning 50 of it, they're expecting 50 less, and therefore now only going to be expecting 150. Make sense? That means we are going to debit accounts payable. Yes, it's a natural credit, but we are decreasing the accounts payable, so therefore we have to debit it since we're no longer required to pay that $50. Debit accounts payable. $50. Okay? And therefore the credit, we already alluded to it, will have to be credit purchase R plus A. Purchase returns and allowances regardless of if it's a return or an allowance. In this case we returned it, so therefore the credit here, $50. But in the perpetual system, what account do we have to always associate in the perpetual system? Inventory. So think about it from the purchase date. You purchased $200 worth of inventory, and now you're returning 50 of it. $50 worth. Which means $50 of your inventory is now going down. Make sense? Also, though, similarly in the periodic system, you are required to pay $50 less than you were initially expected to pay. So that means accounts payable also goes debited here in the perpetual system for the 50. But instead of purchase return and allowance, we are going to credit the asset, merchandise inventory. Merch in, INV, merchandise inventory, which is a debit. We're crediting it to decrease it since we returned it. Okay? And this, it's the same entry if it's a purchase allowance, meaning we're not returning it, but we're just getting a deduction in the price or a reduction in the price because there's something wrong with it. It could be defective, whatever the issue is. Now remember, we purposely stipulated accounts payable as the method of payment. We purchased it with credit. And the reason we do that is because now it's going to expect a payment. And purchase discounts will now become applicable in the recording of this payment. Purchase discounts will have payment terms associated with it. And those payment terms will only apply if you pay for it on credit. Right? If you paid for this with cash here, then these two entries are all you need to do for purchases, if you initially paid with cash. But you are entitled to a purchase discount when you pay with credit. Let that soak in. So true or false? You're entitled to a purchase discount when you pay with cash. False. Exactly. Purchase discounts are associated with paying for something with credit. And the payment terms will look something like this. I can put it down here. Yeah. Payment terms 3/15, comma, N/28. This is an example of payment terms which are related to the purchase discounts. What does it mean? 3/15 means you will get 3% off the price off if you pay within 15 days. And therefore, this 3/15 represents the discount period. Okay. For you multiple choice buffs, for you true and false buffs, discount period is the 15 days because that is the time frame in which, if you do make a payment on this accounts payable, you will get 3% off. Of course, that's something that the vendor has in place. They have, of course, offered that to their customers. In this case, we are the customer, since we're doing the purchasing. But if it is in place, and you do pay within this discount period, you will get 3% off. And there's the purchase discount. And the purchase discount will apply also to the perpetual system, since we pay for that on credit as well. Okay? The N28 portion of this payment of these payment terms means net. The N is net 28, meaning 28 days, and that half of it represents the credit period. Okay, so discount period, disc, PER period, and then the 28 is your credit period. Okay? Which means that if you pay within the 16th day and the 28th day, so those 13 days or so, you don't get a discount because you're not within the 15, but you are still in good standing credit-wise with that vendor. You're still in a good credit relationship with them. Okay? If you pay within there. Okay, so they're still helping you out. They're giving you a little bit of time to pay, but you're not going to get the discount unless you pay within 15 days. Okay? So that's the difference there, and every vendor will be different. Sometimes in the questions you might see 2/10, right, which just means 2% off if you pay within 10 days. So let's pay this accounts payable off within this 15 days. Let's say March 10th. Okay? Let's say March 10th. March 10th, we're paying off what is owing here. And how much is owing in the accounts payable? If we look at the T account, we'll do a T account of accounts payable. On March 1st, we would have done what to accounts payable? In both systems, we credited it. So, right side for 200. On M1, March 1st. Right? But then on March 5th, what did we do to accounts payable? In both systems, we debited it for the 50. So 50 on March M5, BMW enthusiasts. On March 5th, you debit accounts payable for 50, meaning the running total of it is 150 is the current total. Okay, so here's our little side note, side cloud of accounts payable. That means that's how much we owe. We owe the 150, and on March 10th, we are paying off that 150. And then we look at the dates. Dates are always important to keep track of. We go from March 1st to March 10th. Is that within 15 days? Yes. That means we're going to get 3% off of that 150. 3% off of the 150. Okay, so that's going to be what, $4.50? $4.50? Let's just make sure on that. $4.50. 150 times 3%. Yes. Okay. So March 10th, we're making the payment. What is being paid off? Again, we're listing what gets debited first. So debit. What is being paid off is going to be debited. The accounts payable. The 150 remaining on the credit side, we're paying it off, so that's why we will debit it now. Debit the accounts payable in both systems. Okay? We still owe it in the perpetual, just like we owe it in the periodic system. Accounts payable here, 150. Debit. Okay. Good? If we're debiting it for 150, now we have to record the purchase discount. And we're recording the purchase discount in both systems as well because we're within the 15 days granted to us. So that calculation, 150 down here, times 0.03 equals $4.50. So $4.50 off of the 150, meaning we're paying how much? $145.50. $145.50 we're actually paying off in cash, actually and factually. We're paying off $145.50 in cash. That means this $450 in the periodic system will be called purchase discounts. Purchase discounts. And purchase discounts is a contra expense account, which makes it a natural credit, since expenses are debits, right? So, credit, and excuse me, I said purchase discounts a few seconds ago will also apply to the perpetual system. Yes, that's true, it will apply to the perpetual system, but we won't name it purchase discounts, and I'll show you what I mean, but let's get to that, actually, at that point. Credit in the periodic system, I think one at a time is better even for me. In the periodic system, credit purchase discounts here for $4.50. Everybody see how we got that $4.50? Refer to the payment terms, and then it's a simple calculation. $4.50 credited to purchase discounts, but that is obviously heavily outweighed by the $150 on the debit side. So that means we have to also credit something to balance this entry. What are we crediting? We just mentioned it not long ago. Cash. Credit actual, factual cash for the difference, the actual amount that you're paying after the discount is applied. $45.50. Okay. Debit accounts payable $150. Credit purchase discounts $4.50. Credit cash $145.50. And in the perpetual system now, yes, accounts payable will still be $150 because it's being paid off. But instead of using purchase discounts as the name of the account, we are going to apply that purchase discount to where it's still related to the perpetual system, but it will be called what do you think will be the account to use in the perpetual system? What did we say we associate with the perpetual system? We want to always have an update of, good, inventory. So merchandise inventory is the account you credit for $4.50. Because, again, think about it very practically, very logically. You purchased originally $200 worth of inventory. You returned $50 of it. So that means you have $150 available for you to sell at whatever you mark it up at, whatever you decide to price it at. $150 worth your cost, our cost. Now comes March 10th when a discount is applied because we're paying it off within the prescribed discount period of 15 days. And as such, that $150 to us is now only worth $145.50. You see? This helps with our markup. We're going to be able to make more profit now because we have paid with credit. So our inventory goes down by $4.50 on March 10th when we pay off the remaining balance in accounts payable. Got that? Always in the perpetual system, what is the inventory worth right now to us based on the activity of the inventory account? Okay, if we do a T account of merchandise inventory, originally we purchased it for $200, debit side, M1, March 1st. Then, on March 5th, we returned some of it. So, what happened? Credited on March 5th, so 50 on this side. March 5th. Now, on March 10th, we are getting a discount on the remaining 150. So, that discount amount means that the inventory is worth $4.50 less to us, which is better for us to now make more profit with. So $4.50 gets debited or credited in merchandise inventory. Credit merchandise inventory $4.50, okay? Which means that it has a remaining total of $145.50. Get that? $145.50 is the amount of inventory, our cost of the inventory, and now we can do what we want with it in terms of pricing. You got that? And then, of course, the final credit will be the same as in the periodic system because we're paying it off. You're paying off something. It doesn't matter which system it's in. It means you're using cash. So cash will be credited for that $145.50 to balance the equation. Okay, so now you can see the distinction. The clear distinction is that you're using this merchandise inventory account in your entries in the perpetual system, and you're not using it in the periodic system. Okay? The values in the income statement will still mathematically work out for you, regardless of which system you're using, but specifically in the entries, this is how you do each of the recordings under the respective systems. All right? Okay. Digest that. And now let's get into sales. Okay. So now we're going to the opposite viewpoint. Excuse me. Now we're going to the opposite viewpoint of the business. Instead of making the purchase, there will just be an accounts receivable, right? We are now the seller. So think of it through the perspective of the seller to record the following entries in each system. Merchandise inventory is still good. Okay. That and this. Okay. So, debit, credit, debit, credit, the parrot effect is being expressed. Okay, anyway. On March, we'll keep the same dates. We'll keep the same dates, except now, instead of purchasing the inventory, we are taking what was purchased and now selling it at our marked up price. See? And when we were purchasing, we made the association of Perpetual with merchandise inventory, but now we're going to associate Perpetual with cost of goods sold. That's another term to introduce now. Cost of goods sold, which is oftentimes listed as an acronym, COGS or COGS. Okay, so COGS, cost of goods sold, which very simply means our cost of what we sell. How much did you pay for it before you sold it? That's the cost of goods sold. And we'll even talk about now, just briefly, how it's calculated. Cost of goods sold is a minor calculation. Some questions, if we work on practice questions or in the test, or in general in accounting, will provide you with the value of cost of goods sold right away. And then again, you just interpret that as your price of what you are selling, or what you have sold. What you have sold is better, actually. Cost of goods sold only comes into play when you actually sell something. Then you will also record what you bought it for, or what you bought it for. And how do you, let's say that cost of goods sold amount is not provided to you. Is not. That means you're going to have to calculate it. And how do you calculate it? Like this. We take beginning inventory, beginning INV, let's say it's $100. Just making these numbers up. Now, so that means you ended 1 year with $100 left in your inventory, which means just like with capital, you're beginning the next year with that same amount. Inventory is a permanent asset if we relate it back to Chapter 5 or Chapter 4 concepts. It's a permanent asset because its value gets carried into the next period. So beginning inventory, $100. If we now in this period purchased more inventory, we will add it here. Add purchases. Remember purchases? The association with the word purchases is purchasing inventory. So here's where you'll add it. If you added any, let's say we got $100 more. Okay. Add the purchases. Now, you want to find out your cost of goods sold, so you will deduct, we could say less, ending inventory. Okay. Ending inventory, so you see what's happening? We start off with an inventory amount. We added to our inventory. We purchased more with the intention to sell all of it. And then at the end of the period, our ending inventory is, let's say, 70. When you do that calculation now, 100 plus 100 minus 70, you have 130. Right? 200 minus 70, 130, which represents our COGS, COGS, cost of goods sold. Okay? Meaning, this is how much we sold out of our inventory. But remember, cost of goods sold means our cost of it. So it's not the value of the revenue from selling it, but it's our cost of generating that revenue. Okay, our cost of generating that revenue, and this can become even more detailed if you go further into accounting, where you're actually talking about direct materials, if you were, let's say, putting the product together from scratch, and direct labor that goes into actually assembling or manufacturing that particular product. So everything that's directly related to the manufacturing of the product will be used in the cost of goods sold calculation for the purposes of this course. This is as complex as it gets for the cost of goods sold, which is a fair amount of work and a fair comprehension of this particular point, cost of goods sold. And then generally, you consider cost of goods sold an expense. And if you think about it logically, what you sold is the revenue. So this 130 represents how much we paid for what we sold. Let's say we sold all of that for $500. The $500 is the revenue, and the 130 is the expense in the form of cost of goods sold, which is the specific expense. That's, in essence, what cost of goods sold is, an expense. Okay? Our cost of what we sold. But then sometimes, as I say, the question will provide you with the 130 already, implying that they did this calculation. So this cost of goods sold is what we are associating to a perpetual system when we do the entries, the sales entries. Remember that. In the purchases entries, we associated merchandise inventory because we wanted that updated account. And by the way, I'm repeating a lot of this stuff on purpose to hopefully have an effect on you in your making your connections with the distinctions between the two. Merchandise inventory was the association when we're doing the purchasing entries. Cost of goods sold is the association to the perpetual system when doing the sales entries. Okay? So we'll erase this. Cost of goods sold. Now you have an idea what that means. And let's say on March 1st, we sell $500 worth. Let's keep the numbers the same. You sell $500 worth, and just like in our purchases demonstration where we purchased on credit, we will make it so that the customer pays us with credit in these examples. If the customer pays us with credit, we are not receiving cash. And if we're not receiving cash, the very next account that follows cash needs to be debited, and that account is accounts receivable. Okay. Customer pays us with cash. Debit accounts receivable for $500. You just made a sale. Credit, when you make a sale, it's just the opposite of when we said purchases. It's going to be called sales. So the credit in the periodic system will be sales. Sales, we know, is like saying revenue. Sales, sales revenue, or just revenue alone, all of it means the same thing. So there's your sales credit for the same 500 in the periodic system. Okay? And periodic system, that's all you need to do to journalize the initial sale. In the perpetual system, we will also debit accounts receivable when the customer pays us with credit. We will also credit sales because it is revenue. But it is not just going to be left at this entry. There's going to be a second entry on March 1st in the perpetual system when you make that sale. A second entry to record, I'm calling upon the sharp of the sharp, to record, wow, exactly, cost of goods sold. That's the association in the perpetual system. So the cost of goods sold needs to be recorded anytime something sales related happens. If it's a sale, well, specifically if it's a sale or a sales return and allowance. The cost of goods sold also needs to be recorded to show the effect to that account, to the cost of goods sold account. And you cannot record the cost of goods sold unless you sell something. Cost of goods sold, past tense, means we have sold it. And that's the point that you also record the cost of goods sold. And we said cost of goods sold in essence is an expense. That means it has a natural debit balance. So we're going to have to move down the dates here actually. So the periodic ends here for the recording of the sale, but the perpetual is still going. And just think about perpetually, ongoingly, for a longer period of time. Means you have to do more to it in your accounting of the inventory in that system. So you're doing more to it by first debiting COGS for what you paid for it. And then let's use our calculation that we did here in the middle of the board of 130. Okay, now you get that, see what's happening here? Cost of goods sold is being recorded at the same time as the sale. It goes together. We're recording how much we got from the sale and how much we paid for those goods before selling. Right? Okay, cost of goods sold. And what is going to be credited here now? What other account do we associate with the perpetual system? Cost of goods sold and what is always being updated? I think we're just making it there. You can see that, right? Merchandise inventory. Okay. So when you sell the inventory, is your inventory increasing or is it decreasing? When you sell the inventory, it's decreasing. So therefore, the credit to this has to be merchandise inventory for 130. Remember, the inventory value is what you paid for it, not what you sold it for. So that's why you have to decrease it by what you paid for it, not what you sold it for. Be very clear on what is happening in the entry before you record the amounts. The inventory values are always what you pay for that inventory, just like with all other assets, which we called from chapter 2, the historical cost. The historical cost is what you pay for it, what you record it at, regardless of which period you're recording it in. You have to always record that asset at what you paid for it. This is what we paid for compared to what we sold. Okay? So that means those two make up the perpetual entry on March 1st. There's just more to do in the perpetual system. Again, it's a more thorough, more detailed system. A more accurate system. Now comes March 5th. Well, actually first, remember in the purchases where we made that association with the three accounts together. Purchases, purchase returns and allowances, and then purchase discounts. Very similarly, just flip that over and apply it to sales. You have sales, sales returns and allowances, and sales discounts. And they mean the same thing as they did in the purchases discussion. This time, the sale means the customer, if they're doing a sales return and allowance, either they don't like something, so they're returning it. That would be the sales return. If it's a sale allowance, it means that they are not returning it. They're still keeping the item, but they want a reduction in the price because there's something wrong with it, or it's not matching what they actually ordered. Quantity, size, color, shape, product, whatever it is, defective product. They want a reduction in the price. We're using sales returns and allowances either way. So it just depends on who's doing it. In this case, the customer might be returning something, so we would be calling that a sales return and allowance. And then, of course, sales discounts instead of purchase discounts. Okay? And then also, really quickly, the sales calculation, you have a net sales calculation. Remember when we did the income statement, we started off with revenues minus expenses equals net profit or net income. And we're saying that sales is revenue, but if it's a more detailed income statement, like a classified income statement, we'll still talk about that more coming up. But if it's a more detailed income statement, you will start off that income statement at the top with net sales. And how do you calculate net sales? By taking sales minus sales returns and allowances minus sales discounts. All three of those will be listed at the top of the income statement. They're all income statement accounts. Sales is a revenue account. Sales returns and allowances and sales discounts are both contra revenue accounts because they decrease sales and therefore are natural debits. Contra revenue accounts, but they still get listed on the income statement because they are still revenue accounts, despite being contra. Good? Equals net sales. And then that net sales figure is what we continue from as we go down that income statement. So that's how you calculate net sales. And net purchases will be calculated the same way. Purchases minus purchase returns and allowances minus purchase discounts equals net purchases. Purchases natural debit, purchase returns and allowances, purchase discounts, contra expenses, therefore natural credits. But all of them also get listed in the income statement where the purchases go, and the purchases go in that cost of goods sold calculation that we did not too long ago. Remember when we started with beginning inventory? What do you add to beginning inventory? Additional purchases. So that means net purchases, really. Net purchases. Then you deduct ending inventory to give you cost of goods sold. So that's where they both go. Net sales, top of the income statement, and net purchases will be very soon to follow that on the same income statement because it is in essence an expense. Okay? Again, we'll talk about that more when we talk about the income statement. But now on March 5th, we'll put right here. Sales return and allowance means that the customer is now returning goods to us. We sold them $500 worth, and they're saying, well, we'll keep $400 of it, but the $100 worth of it we don't want. We're going to send it back to you. So that means we cannot consider $100 of it accounts receivable anymore. We were initially expecting $500, but now we can only expect $400. So that means we have to bring down accounts receivable by $100. But before we do that, we have to debit what? What are we going to debit? What is the contra revenue account that brings down sales in this scenario of a return? Sales, returns, and allowances. So sales, R plus A, returns and allowances. The full name gets written out every time. Sales, returns, and allowances is the debit for, we'll put it here on March 5th, excuse me, debit erase this part. Okay. See what's happening here? This is March 5th. Debit, sales, returns, and allowances on March 5th. Credit, debit, sales, returns, and allowances, 100. What are you expecting $100 less of? Accounts receivable. So accounts receivable will be credited here for the same 100. Okay, let's do that in a T account. We converted this accounts payable T account to an accounts receivable T account. On March 1st, what did we do to accounts receivable? Debited it in both systems for 500. So here's 500 on M1. And now on March 5th, what do we do to accounts receivable? Credit it for 100, March 5th. So how much is left in accounts receivable? 500 minus 100. Now we're only expecting the customer to pay us $400 because they returned 100 of it. So in the periodic system, we're done recording that sales return and allowance. Now we record it in the perpetual system, and we already know that the perpetual system is going to require a little bit more detail. We will start off with the same entry. Okay. Sales return and allowance will also be debited here for the 100. Accounts receivable will also be credited for the 100. But now, since it's a perpetual system, we have to do this additional entry to recognize what is happening to cost of goods sold and merchandise inventory. So now our cost of that $100 worth of the sale, let's say, is $20. $20 is now going back into the inventory. So we're not just going to be doing exactly the same treatment. We are using these two accounts, but we're going to treat them a little bit differently now, based on what is happening. Think about what is happening. The customer has returned some inventory back to us. So what is happening to our inventory? Is it going back up, or is it decreasing when it's returned back to us? Very logically, it is increasing. We're putting it back into our inventory, back into our warehouse. That means merchandise inventory, an asset, a natural debit, needs to be debited here. See, periodic entry finished. Debit for merchandise inventory for $20. And that's our cost of the $100 that they have returned. The $100 revenue. Our cost of that $100 revenue is $20. Just made it up. Okay, which means we cannot consider that $20 a cost of goods sold anymore. It is that $20 worth of inventory to us cannot be considered sold since it has been returned. Cost of goods sold can only increase when a sale is made. So that means cost of goods sold will be a credit here. COGS 20. There you have it. Let's look at what's happening to merchandise inventories ledger. On March 1st, what happened to merchandise inventory? Credit for 130, right? Because we sold it, so our merchandise inventory is going down. We therefore credit it. And what's happening to merchandise inventory on March 5th? It's being debited for 20 because we're putting it back into the inventory. Customer returned it to us. We're putting it back in. So inventory has to go up on March 5th. Here's M1. Okay. So based on these two numbers, if there's no other numbers in the inventory account, what is left in our inventory? Well, it would be a negative 110. So obviously we have some other inventory in here. But just to do the correct math here, negative 110 based on these two numbers, if these were the only two numbers. So that's how you record the entry in a perpetual system, a return. 4 accounts need to be shown here. You got it? And if you're ever wondering why do you treat an account a certain way, why do you debit it, why do you credit it, just ask what is happening to it. What is happening to inventory here? Are we getting it back? Are we selling it? Then it's very easy to say if it's going up or down. And cost of goods sold, same thing. If we made the sale, then we record what we paid for it, and then of course cost of goods sold goes up. But if the customer returns it to us, then we cannot consider it a sale anymore, and therefore cost of goods sold goes down. Okay? And then lastly, to record the sale discount. Now the customer will do the same payment terms. Let's say we offer the 3/15, comma, net 30, or net 28. The customer pays within the 15 days, down here, March 10th. Okay? They're paying off what? Okay. The accounts receivable, which means it will be good, credited. We know we have to first list what gets debited. So when the customer pays off the accounts receivable, what are we getting? What are we converting the accounts receivable into? Exactly, cash. So this, by the way, here's the perpetual entry, there's the periodic entry. On March 5th, March 10th, we received the cash. If we're receiving the cash is increasing. But they're paying within the discount period, within the 15 days, which means they're going to get a discount, and therefore we're not going to get this full 400. We can't get the full 400 because we have to deduct the discount we're giving them. 3% of 400, $12. Right? 3% of 400 is $12. How you do that in the calculator? You type in 400 times 0.03, and that will give you the 12. Customer's getting a $12 discount. That means we're only getting the actual factual cash of 400 minus 12. So we're getting cash of 388. Cash here, 388. Get that? If it happened after the 15 days, we would get the full 400. But we gave them the discount period option, and they have taken advantage of it. We're getting the $300 or $388 in cash. We have to now record the sales discount. Okay, so the sales discount we know brings down sales, just like sales returns and allowances brings down sales. So if sales returns and allowances is debited when it gets used, sales discounts also gets debited. So our second debit here sales discount for debit it for $12. Okay? Debit it for $12. And now the debit side has $400 on it. And we know we have to balance the entry by also crediting $400 worth to what? What is being paid off here by the customer? The accounts receivable. This 400. So credit credit AR, accounts receivable, 400. Okay? And that's all you have to do for that periodic entry. Periodic, just one entry no matter what happens. But in the perpetual, in these two cases, it was a double entry in each. But with the sales discount now, we're just going to have to trade sales discounts for merchandise inventory. Sales discount for merchandise inventory, but we're no longer recording this cost of goods sold here because nothing has been sold here. and cost of goods sold is not decreasing since nothing has been returned. On a sales discount, cost of goods sold does not get impacted with the sales discount only. So, in the perpetual system, you are still receiving the cash. So that's the debit for $388. But instead of calling it sales discount, what are we calling this $12? Well, actually, no. We will call it sales discount here as well in this perpetual system. We'll call it the sales discount because... Hold on. Let me think about this. Let me think about this. Breaking the action, I'll take a little sip of water. The answer will come to me. Answer will come to me. Yes. Okay. So as I say, sales discount will also be credited here, debited, excuse me, for the same 12, and accounts receivable, since it's being paid off, will be credited for the 400. Why are we using sales discount here? Just like in the periodic system? Because the sales discount will show either way in the income statement. Remember the top part of the income statement? We're going to show sales, sales returns and allowances, and sales discounts all in a trio on the top of that income statement. And we have to show how the sales has decreased. Why has it decreased if no return has been made? We have to explain why sales has decreased if no return has been made, such as when there's a sales discount. And when there's a sales discount, just like with COGS, merchandise inventory doesn't get affected here. Okay? Just like with cost of goods sold. Why doesn't merchandise inventory get affected here? Because we're not putting anything back into inventory and we're not taking anything out of inventory. That was already determined at the point of this first sale on March 1st, what happened to inventory. And then it changed on March 5th when a sales return was made by the customer. But when the discount is made, nothing is happening to inventory. They're just simply getting a reduction in the price because they're paying within the discount period. That's the only difference. That's why this entry on March 10th will be the same in both systems. Okay? Because cost of goods sold and merchandise inventory does not get impacted when the customer pays on time. And if you think about it logically, just like we just explained, the reasons why, that's why. And why do we offer the customers a payment term or an opportunity to have a discount? And why do vendors offer that to us? Why is that even an option? Well, it's to entice payment. You are expecting payment of this accounts receivable, and you're just trying to attract them, and entice is a better word actually, entice them, tempt them to actually make the payment to you. And if they're getting a discount, they're more inclined to make that payment. And it's basically a strategic method to receive your payment, because when you have an accounts receivable, you expect that some of that accounts receivable will be uncollected. Okay? 100% of the accounts receivable is an unrealistic expectation to collect 100% of it. There's always a portion that you will not collect, and therefore to increase the probability that you will collect as much as possible, you offer these payment terms so that the customer has a benefit to paying you and where both people win. Okay? Both parties win in that transaction. There you go. Know that. Know the perpetual periodic system. This is a main part in this chapter. And now let's talk about the income statements a little bit, and then we'll get into taxes. Again, focusing on inventory in this chapter only. That one asset account of inventory. That is the focus here. The one asset account. And since it is an account that gets purchased by us for the intention of selling and then ultimately sold by us, the sale of it is the revenue, the purchase of it is the expense, and that's why the income statement, dealing with revenues and expenses, is the financial statement that we focus on in this chapter as well, as opposed to the statement of changes in equity and the balance sheet. Okay? And I don't know if I mentioned, I don't think I mentioned actually, in the other videos, that sometimes you'll see the terminology statement of financial position, which is the balance sheet. It's just another name for the balance sheet. Just comes to mind right now to mention that. Okay, it's not another financial statement, just an alternate name to the balance sheet. But again, this chapter, income statement, and we have three types. So you have a classified, multi-step, then you have a multi-step, and then you have a single step. These are the three types of income statements. Okay? And how they differ is the amount of information that they provide. Classified will be the most detailed out of the three. The most detailed and the one that is more privy to the internal users. All those involved in the financials and in the accounting department, in the budgeting, the CFO, everybody internal to the organization will have the accessibility to this classified income statement, and really it's just more details, but all three of them will result in the same net profit amount at the bottom anyway. Okay? Because you're still doing the same math, it's just you're showing more details in the calculation in the classified multi-step, and then a little bit less detail in the multi-step than in the classified, but still more detail in the multi-step than in the single step, which is very limited in terms of how the numbers got there, but it's still showing you the main numbers, the revenues, the expenses, and the net profit. The single step is the one we are most familiar with so far in this course, since this is the one that just lists all of the revenues together at the top. Any kind of revenue gets listed, as we've been doing, minus operating expenses, all of the various operating expenses, and then deduct the total expenses from the total revenues to give us net profit or net income at the bottom. That's what a single step is. Simple as that. But we break down those revenues and those expenses a little bit more when we get into the multi-step or the classified multi-step. And these two then are more for the external users, whereas this classified multi-step would be more for the internal users. Internal, external users, they're both considered stakeholders. Both have an interest in how the company is performing. And again, whoever's internally involved in the company will have more details available to them. And that's why classified, and classified is the clue. Classified information, okay? Exclusive information, only for the internal individuals. So the single step we know. We just said that's what we're familiar with already. Multi-step, though. We're getting a little bit more detailed with each of the revenue and expenses section. Remember when we talked about net sales? We talked about net sales. In the multi-step, we're just going to write net sales at the top of it. So here's the multi-step. You have net sales at the top of that income statement, meaning that the number has already been provided to you. Let's say it's 100K. That means sales minus sales returns and allowances minus sales discounts has already been calculated to get this number, and therefore sales returns and allowances and sales discounts is not listed in this multi-step. It's just saying net sales, which implies that the calculation has already been made. And from the net sales, you're going to show COGS now, cost of goods sold, which also will not be detailed on how it was calculated. Okay, cost of goods sold gets directly subtracted from net sales. Let's say it is 5K. Cost of goods sold directly gets subtracted from net sales to give us what's called gross profit. Gross profit, meaning we're still going to have to deduct something from it. Gross profit can also be called gross margin. That's just terminology. It means the same thing. It means the difference between net sales and cost of goods sold. So we know net sales now. We know how to record all of the different sales. And cost of goods sold will only be given this final total of cost of goods sold, but we know from earlier that cost of goods sold has its own calculation, which includes purchases, which includes net purchases, right? So cost of goods sold, gross profit margin will be now 95,000. 100,000 minus 5,000, 95,000. Gross profit margin, gross, meaning we still have to deduct something to get a net. And what are we deducting? Operating expenses. So our regular expenses. So operating expenses, again, this is the multi-step. Number 2. Okay. This is the multi-step operating expenses. And we will list each of them. Salaries expense, rent expense, utilities expense, all of our expenses will be listed under operating expenses, but we will not categorize the operating expenses. We're just going to list them all as they happen or as they're added on based on if there's adjusting entries or whatever. But they all go together, and then we get a total of those operating expenses, which now get deducted from this gross profit to give us ultimately, well, no, then you still will be deducting if there's additional revenue or additional expenses at the bottom. And then if there is additional revenues, such as rent revenue or interest revenue, stuff like that, that has happened afterwards, not in the operation of the business necessarily, that will be added at the bottom. Any additional expenses, maybe there's interest expense this time, that will also be deducted at the bottom, so the revenues and expenses still get treated the same. And then once you do that calculation, you'll get a net income at the bottom. So the goal is still the same, regardless of which 3 of these income statements you are preparing. You're still getting a net income at the bottom, except you have to go through the steps of net sales minus COGS to give you gross profit, then deduct operating expenses to give you net profit. Okay, so a little bit more detail in the multi-step from the single step. And now you can imagine when you go from the multi-step to the classified multi-step, you're getting even more detail. And what does even more detailed mean? It means you're now showing exactly how you got the net sales. So you're going to list sales, sales returns and allowances. We already did it. Okay. If you're taking notes. If you were taking notes. And sales discounts. They all get listed in this classified statement. We want to know exactly how much has been returned, how much has been discounted, and how exactly this net sales figure has been calculated. So all three of those will be listed, and then that fourth line will say net sales to explain how net sales was derived at. Then you will still have cost of goods sold. The cost of goods sold calculation is still not necessarily shown in the classified income statement. You're still going to have this one number here, but there sometimes will be an appendix or an additional document that will have the calculation of cost of goods sold attached to the financial information that you are providing somebody. So the explanation will be shown somewhere else, but still, even in the classified statement, we're just showing it as cost of goods sold. We already know how to calculate it. Again, beginning inventory, plus additional purchases, additional net purchases, and net purchases are calculated the same way as net sales by taking purchases minus purchase return and allowance minus purchase discounts. So when you add those net purchases to beginning inventory and then deduct ending inventory, you will get cost of goods sold. That's how it's calculated. It's a brief calculation. That's the extent to cost of goods sold for this course that you need to know. And then same idea, you get a gross profit from that. Net sales minus cost of goods sold gives us gross profit, gross margin. And then what we're going to do in the classified statement is categorize operating expenses as either selling expenses or administrative expenses. So it's the same listing of all the expenses, except we're going to group them now. Selling expenses will be a subcategory under operating expenses. Again, this is for the classified statement now. Okay? And administrative expenses. So you can just think very logically, in the operation of the business, what expenses are going toward your selling efforts, okay, paying the sales staff. So sales salaries expense. Okay, advertising. Well, advertising actually is administrative expenses. If you're paying the office workers though, not the salespeople on the floor, but the office workers, that will be considered office salaries expense. And office salaries expense is an administrative expense. Sales salaries expense is a selling expense. So you see, you're just getting more detailed with the operating expenses section as it relates to the business, as it relates to your specific activity in the business, specific operating activity. Okay? So selling expenses, administration expenses get detailed in the operating expenses section, and then ultimately at the bottom, any additional rent or any additional revenue, interest revenue maybe, any additional expenses get added or subtracted respectively, whichever of the two, to ultimately get a net income at the bottom. Again, all three of these will get, the goal of them is to determine a net income, of which if you did each of these three, you did all three of them, you will get the same net income in all three of them. It's just how much detail are you providing. Okay? So it's good to know. You know how to calculate net sales. You know how to calculate net purchases, which is part of the cost of goods sold calculation. You know how to calculate cost of goods sold. You know how to break down now each of these income statements. There is a comparison in the PowerPoints of all three of these to give you a good example of it, as well as in the textbook. And there it is. And let's talk about gross profit margin now. Gross profit margin, if you're ever asked, it's just a quick calculation. It wants to know how much profit are you making in relation to your sales. So if you have a net sales of 100,000, that's going to be your denominator at the bottom of the equation. Net sales, at the top will be the difference between your sales and your cost of goods sold. So, in this case, 95,000, which is a great profit margin. Really good profit margin here. You might hear that in the investment world. What is your profit margin? And that's based on how much, basically it's saying, what is the percentage of the profit you are making in relation to your sales? We see your sales, but we know that your sales are not all profit. They represent revenue, which is not profit. Revenue has to deduct expenses before we can call it profit. And we want to know how much profit are you making in relation to those sales. And therefore, that's how you calculate gross profit margin. Okay, gross profit margin. And that's how to explain what it means. And then there's also a markup percentage. Markup goes back to our perpetual periodic explanation when we were differentiating between purchases and sales. And we say that your markup is the difference between your price and the cost over the cost, so that you can determine how much you've marked it up by. That's the explanation of it. So markup percentage, this is related more to purchases and sales specifically. If you consider it with one item, let's say with an item you sell it for $10 and you bought it for $5. Keep the math simple. That means at the top you're saying 10 minus 5, price, your selling price, minus your cost, over your cost. And that will give us 5 over 5, which means it's a 100% markup. How much have you marked the price up by? That's how you calculate. In this case, it's a 100% markup. Get it? Okay, and what else do we want to cover? Expense or taxes. Taxes, yes. That's right in line with the season coming up. And specifically, how does a business interpret taxes? How does a business record taxes? And who does it communicate that information to? So, you know that you're with the inventory. You are purchasing inventory with the intention to sell, and then you are selling it. If you're purchasing it through the supplier, you are paying taxes on that, right? And then if you're selling it, the customer is paying you the taxes. And again, we're concerned with how it is affecting the business. So whatever is coming into the business, well, let's start with the purchases. Whatever is going out of the business, we're purchasing, so now we have to record the taxes related to that purchase. And we'll just name the accounts. We'll say PST, GST, HST, okay, provincial sales tax, goods and sales tax, harmonized sales tax. And the harmonized is a combination of the PST and the GST. In Ontario, we have 8% for PST, provincial. Goods and sales tax is at 5%, which means HST is 13%. All right? Provinces differ, but if we're recording it in Ontario, these are the accounts we'll use. If we are paying the tax, meaning it's connected to our purchases of the inventory, to us, we have to keep track of those taxes using PST payable. PST receivable. PST receivable, and we'll explain why. PST receivable because you have to disclose that amount to the CRA, who is now going to essentially pay it back to you come tax time. And it will, of course, be contrasted with how much you collect, so you have to do that comparison. But the account will be called PST receivable, GST receivable, HST receivable. Okay? So receivable. Okay? And then those same three will also be called payables to be connected to the GST that we are paying or that we are collecting. I'm getting caught up with the language here, payable and paying. No. If you're collecting it, then it is a payable to you. Payable to you because now you're going to be paying that back to the CRA, whereas the CRA is paying you back what you have paid. You see? So that's why what you collect from your customers in the form of taxes is to you, to our business, considered a payable. And then you get a total, let's say, in all of your collections, from your customers, you received tax for the year of just the taxes portion, let's say 50,000. Collected. Collected, which means it's connected to our sales. The customer paid the tax to us. But we have to keep track of that tax. We can't consider it profit. We can't keep it into investing in so that we invest it into the business anymore. We have to keep it in its own tax account to represent what has been collected. 50K we collected, and how much did we pay in taxes connected to the purchases of our inventory? Let's say 20,000. Paid. Now we have to the CRA, we have to communicate both of these numbers. Of course, we can do the calculation ourselves, but we still need to tell them how much we collected and how much we paid in taxes. Both of these, by the way, PST receivable, GST receivable, HST receivable, that's all essentially one account depending on which tax is applied, depending on what products are being sold. Some products are not even taxed, right? So, these three also apply to payables. GST, PST, and HST are all payables as well. So what you're going to do is get a total and call this GST, we'll say it's HST actually, HST payable 50,000, HST receivable 20,000. If the payable is higher than the receivable, as it is in this case, means you collected more tax than you paid. Right? You collected more than you paid by 30,000. That means it's going to have to be a remittance. It's either going to be a remittance that they will determine or a refund, as you might be familiar when you file your taxes. A remittance means that you have to pay the government back, Canada Revenue Agency back. A refund means that they have to pay you. And you have to pay them if you collected more in your business than you paid. That's the yin and yang of selling more than you're purchasing. So obviously, it was a positive thing that you sold more, but now you're being penalized for it, essentially, when it comes to taxes, by needing to pay it back. You're going to have to pay back this $30,000. If, however, you paid more than you collected, that's not good for the business, obviously, but it does help you when it comes to tax season, because now you will get what's called the refund from the CRA, which means they will pay you back that difference. Okay? That's why both directions of where the tax is going, whether you're paying it or collecting it, needs to be recorded and communicated to the CRA so that they can send you back the appropriate refund or remittance based on those numbers. And then how are they recorded? How are they recorded? You make a purchase. We'll do the purchase side first to be consistent with our earlier discussion. You purchase inventory of $200. Okay, so purchases in the periodic system. Periodic, perpetual. Okay. Purchases, debit, DR, for 200. But there's that 13% tax we have to pay on the purchases. What's 13% of 200? 26. So just like the purchases, debit, HST because we're using the 13%, HST, receivable. Why is it a receivable? Because if we're paying it, we're going to get it back from the government. That's how you think about it. Whatever you pay in taxes, you will be paid back from the CRA. And if you're going to be paid back that amount, it's a receivable to you. Right? So since we're dealing with purchases, let's just keep it at that for now. 426. Both debits. It's following purchases. Taxes follow, whether it's a purchase, it will follow purchases. If it's a sale, the tax will follow the sale. So that's on the debit side, and therefore the credit will of course be purchases, however we paid for it. So let's say accounts payable. We'll keep that credit purchase. If we paid for it in cash, cash gets credit. For 226. Good? I think so. Okay, and then just the only difference in the perpetual system is that we're using that associated account. Instead of purchases, we are going to debit the asset that we're getting. Of course, in this chapter, the asset is inventory. So, merchandise inventory for the 200, but these two will be the same. Okay, and now, so that's how you record taxes in the context of a purchase of inventory. Okay. Purchase, and here is a sale. How do you record the sales tax in each system? So now you make a sale of $400. You sell $400, customer pays you with credit, not cash. If they pay you with credit, accounts receivable goes up by 400. Okay? The customer is paying us the 400, so we are charging them the tax. If we're charging them the 13% on the 400, what is 13% of 400? 52. Okay, 52 that'll be the debit side. So now we can credit wait a minute. Credit, let me put the 52 here so I don't mislead you here. Okay, 52 is the tax portion. 52 is the tax portion. Let me write down HST payable. HST payable for 52, and sales will be credited for the full 452. Okay? Or, no. Accounts receivable is the full payment. It has to be 2 credits in the sales entry. Excuse me. On video, guys. On video. Okay. HST payable has to be a credit. Okay. Sales will be for 400 because you're not considering the tax part of sales. Tax is recorded separately. And then accounts receivable will be for the full 452. That's how we do that. Okay? In a purchase entry, you have 2 debits. In a sales entry, you have 2 credits. There we go. We got it. We got it now. Okay? And why is it called HST payable in a sales context? Because whatever we collect, right? If we're making a sale, we're collecting, we have to pay back. And that's why it's considered a payable to us. Remember, these accounts are all as they relate to the business. Okay? 2 debits in a purchases entry, 2 credits in a sales entry. And both of them, by the way, HST receivable and HST payable, they're both liabilities in the balance sheet. Why are they both liabilities? Because you have to give them both to the CRA, and then they will pay you back either the refund or you will have to pay them back the remittance. But either way, they're both liabilities because they both have to go to the, whatever you collect goes to the CRA, whatever you pay in taxes goes to the CRA. You see? That's why they're liabilities, because we still have to send them somewhere. We still have to pay them. And then they will do the calculation to send it back to us if it's a refund. And it's a refund if you paid more than you collected. It's a remittance, meaning you have to pay them if you collected more than you paid. That's what to keep in mind with taxes. And that's what every business has to manage. How much taxes they're collecting and how much they're paying. And then make that comparison and communicate it to those individuals. Okay. I think that's it, folks. I think that's it. Oh, perpetual. Excuse me. Let's do it in the perpetual system. Okay. Where, since it's a sale, it will be recorded the same way. You're not going to use that inventory account since you're not using purchases in the periodic system. You see, so you don't have to trade anything off. But you will have to do that additional entry of cost of goods sold, right? So there's a double entry, but it's not going to be the contrast as with the purchases. Let's demonstrate. Accounts receivable here, debit for 452. Okay, this will stay the same, this will stay the same. So it's the same entry in both systems, but then you'll have that second entry, cost of goods sold, merchandise inventory, to only record your cost of those goods the same way we did when we recorded it earlier in the video. Okay? Your cost of what has been sold gets debited under the cost of goods sold account, and then that same value will be crediting inventory to indicate how much inventory has gone down in value. Okay, so it's just that double entry in the perpetual system because it's a sale. But learn that, review that comparison, rewind the video if needed. It's all here for you. Any questions? You know how to reach me. And definitely use the discussion boards more if you feel it's necessary. Request different questions if you feel they are necessary to be taken up. And let's wrap it up there. Okay, next week, chapter 6, where we get into evaluating inventory a little bit. But this was a good foundation to tackle that chapter with next week. Okay. Good night.